Your last year before retirement. Don't make these 4 costly mistakes. You are 12 months away from the finish line. This is exactly when people destroy everything they spent 40 years building. You have done it. Decades of work, sacrifice, early mornings, late nights, delayed vacations, and disciplined saving. The finish line is finally visible. Retirement is 1 year away. You can almost taste it. And this, right now in this final year, is the single most dangerous period of your entire financial life. Not because the market might crash. Not because of inflation, not because of anything happening in Washington, but because the year before retirement is the year people make the 4 most catastrophic, permanent, irreversible financial mistakes of their entire lives. Mistakes that cannot be undone once retirement begins. Mistakes that do not just hurt, they follow you for the rest of your life, compounding the wrong way every single month until you are gone. I am going to tell you exactly what those 4 mistakes are. And I am going to tell you in plain language with real numbers what each one actually costs. Because the people who make these mistakes are not uninformed. They are not careless. They are smart, hard-working people who were so close to the finish line that they stopped paying attention to the last few steps. And those last few steps are everything stay until the end. Because mistake number 3 is the one that almost nobody sees coming. And it is quietly happening to thousands of pre-retirees right now. Mistake 1, claiming Social Security at the wrong moment. This is the most permanent financial decision you will make in your entire retirement. There are no do-overs. There is no appeal. The month you file is the month that locks in your benefit for the rest of your life. And the single most common mistake people make in the year before retirement is filing too early, driven by impatience, by anxiety, or by a fundamental misunderstanding of how the math actually works. Here is the reality. If you do not wait until full retirement age to claim your benefits, they will be reduced on a permanent basis. For someone born in 1960 or later, full retirement age is now 67. That is the age at which you receive 100% of your calculated benefit. File before that, and you receive less permanently. File after that, and your benefit grows. How much does filing early actually cost? If your full retirement age benefit would be $2,000 per month, and you claim at 64, you are looking at roughly a 20% reduction. Instead of $2,000 per month, you receive $1,600 per month instead. That is $400 per month, every month, for the rest of your life. Over 20 years of retirement, that difference is $96,000. Over 25 years, it is $120,000. And that is before accounting for COLA adjustments that compound on the lower base amount. Now flip it the other direction. Retirement benefit amounts increase by 8% for each year. You delay past full retirement age up to age 70. Someone with a $2,000 full retirement age benefit who waits until 70 receives approximately $2,480 per month instead. That is an extra $480 every month for life. Over a 20-year retirement, delaying to 70 rather than claiming at 67 adds nearly $115,000 in lifetime benefits. The year before retirement is the year to run these numbers. Not the month before you file, not the week you call Social Security this year. Right now, because the decision you make in the next 12 months locks in a number that follows you to the grave. One more wrinkle that catches people off guard. Your Social Security benefit is calculated using your earnings record. The income you have earned and paid Social Security taxes on over your entire career. If there is a mistake in your reported earnings, that could affect your future benefit. Log into your My Social Security account at ssa.gov right now and verify that your earnings record is accurate for every year you worked. Errors in the record lower your calculated benefit, and they are your responsibility to catch and correct before you file. Mistake 2, ignoring the Medicare income trap here, is a mistake that affects people who have done everything right. People who saved diligently, people who built a significant retirement nest egg, people who made smart financial decisions for decades, and it hits them in the final year before retirement because they did not understand a 2-year look-back rule that determines how much they pay for Medicare. This is called IRMAA, the income, related monthly adjustment amount, and it means that if your income in the 2 years before Medicare begins was above certain thresholds, you pay significantly higher Medicare Part B premiums for the entire following year. In 2026, the standard Medicare Part B premium rose to approximately $202 per month. But beneficiaries with incomes above $109,000 for individual taxpayers and $218,000 for couples filing jointly pay higher premium rates. Those higher rates are not trivially higher. Depending on your income, they can be 2, 3, or even 4 times the standard premium, adding thousands of dollars per year to your healthcare costs in the first years of retirement. The IRMAA determination uses your income from 2 years prior. This 2-year look-back means that actions you take in the year before retirement, a large Roth conversion, the sale of a rental property, a business sale, a large IRA distribution, can trigger higher Medicare premiums in your first or second year of retirement, even if your retirement income is modest. The mistake people make is taking a large financial action in the year before retirement without calculating the Medicare premium consequence. First, they do a Roth conversion, they sell the vacation home, they take a large distribution to pay off the mortgage before retiring. All of these might be reasonable decisions in isolation. All of them can trigger IRMAA surcharges that cost thousands in higher Medicare premiums. 2 years later, qualified distributions from Roth accounts are not factored into the income calculation for Medicare premiums. Partial Roth IRA conversions done during working years may achieve tax diversification while avoiding higher Medicare Part B premiums. In other words, the year before retirement is not the time to do a large lump sum Roth conversion. It is the time to have a specific conversation with a financial advisor about how your income in this final working year affects Medicare premiums 2 years into your retirement. The good news: the new senior tax deduction introduced through recent legislation provides seniors age 65 and older with an additional deduction of up to $6,000 per individual, starting with the 2025 tax year. To qualify for the full deduction, you need a modified adjusted gross income below $150,000 for joint filers or below $75,000 for individuals. Understanding how this deduction interacts with your income level in the pre-retirement year is another reason to review your tax situation now rather than in April. Mistake 3. Not checking the Social Security Trust Fund timeline. This is the one I promised you. And I know it sounds abstract. Something happening in Washington that feels like it has nothing to do with your retirement check. But the numbers that were just released are not abstract at all. They are a specific date. And that date may land squarely in the middle of your retirement. A Congressional Budget Office report from February 2026 estimates that the Social Security Old Age and Survivors Insurance Trust Fund depletion date has advanced to 2032, a year earlier than previous projections expected. If you are retiring this year at 65, that is 7 years from now. If you retire at 62, it is 10 years from now. What happens when the trust fund is depleted? Benefits do not stop, but they get cut automatically by law to whatever level can be sustained by incoming payroll taxes at that time. Current projections suggest that level is approximately 75 to 80% of scheduled benefits. That means someone expecting $2,000 per month from Social Security might receive $1,500 to $1,600 per month instead. The reason this qualifies as a pre-retirement mistake is not because you can prevent the trust fund from being depleted. You cannot. The mistake is building a retirement income plan that assumes your full scheduled Social Security benefit arrives every month for the next 30 years, without any contingency for what happens if it does not. The year before retirement is the time to run your numbers at 75% of your projected Social Security benefit, not 100%. If your retirement plan still works at the lower number, because you have sufficient savings, a pension, or other income sources, you can retire with confidence. If it does not work at the lower number, you need to know that now while you still have time to adjust, not in 2032, when the adjustment choices are gone. Mistake 4. Treating this final year like any other working year. The fourth mistake is not a single decision. It is an attitude. And it is the attitude that says, I have done the hard work, I can coast through this last year. There is nothing important left to do before I hand in my badge. That attitude is wrong in ways that cost real money. The year before retirement is the year to maximize your retirement account contributions more aggressively than any other year of your career. Because the dollars you contribute this year are the ones that have not yet been exposed to sequence of returns risk. They are the fresh dollars sitting in your account when retirement begins. The 401 contribution limit in 2026 allows workers 50 and older to contribute the standard limit plus a catch-up contribution. Workers between ages 60 and 63 have an enhanced catch-up contribution limit under Secure 2.0 provisions. If you are in this age window and you are not maxing your catch-up contributions in this final working year, you are leaving tax advantage money on the table in the last year you have the opportunity to make it. This is also the year to get specific about your healthcare bridge. If you retire before 65, before Medicare eligibility, You need a plan to cover healthcare costs for every month between your retirement date and your Medicare enrollment date. Marketplace coverage through the ACA is available, but the premiums can be substantial depending on your income in retirement and whether you qualify for subsidies. If you retire mid-year and your income drops significantly, your subsidy eligibility changes. Not having a specific month-by-month healthcare coverage plan in place before you retire is one of the most common sources of unexpected first-year retirement expenses. This is the year to review your beneficiary designations on every account. 401k, IRA, life insurance, annuities. Beneficiary designations override your will. They do not care what your will says. If your beneficiary designation on your 401k still names an ex-spouse, a parent who has since passed away, or a child whose circumstances have dramatically changed, those assets will flow to that person regardless of your current wishes. A beneficiary review takes 30 minutes. The consequences of skipping it can last generations. And this is the year to get honest with yourself about your actual retirement spending estimate. Most pre-retirees underestimate what they will spend in retirement, not on luxuries, but on healthcare, on helping adult children, on home maintenance for the house they plan to age in, and on the leisure activities they spent 40 years looking forward to. Coordinating Social Security, Medicare, and retirement withdrawals is one of the most effective ways to avoid unnecessary taxes or income stress. But that coordination requires knowing what you will actually spend, not what you hope to spend. The bottom line, you are 12 months from everything you worked for. The finish line is real, and you are going to cross it. But the 4 mistakes in this article: claiming Social Security at the wrong moment, triggering the Medicare income trap, ignoring the trust fund timeline in your planning, and treating this year as a year to coast, are not hypothetical risks. They are the documented financial errors that financial advisors see repeatedly in clients who arrive in retirement with plans that cannot sustain them. This final year is not the time to relax. It is the time to be more deliberate, more specific, and more proactive than you have been at any previous point in your financial life. Retire right. You have earned it.